Hershey, ticker symbol HSY, is down 13% this year. In this video, we're going to be talking about why it's down, looking at their financials, and if their dividend is safe. For those that don't know, Hershey's is a chocolate and candy company. Here are some of the brands that they own, which include Skinny Pop, which is popcorn, Hershey's, obviously, Reese's, Twizzlers, Kit Kat, and so on. They have some of the biggest brand names in the US. They also have the biggest market share. They have 45% of the market in US chocolate and 31% in the mint and gum category. One of the reasons why Hershey's has dropped so much is because of the price of cocoa. As the price of cocoa rises, it creates higher expenses for Hershey's. So, in turn, Hershey's profit margin has slightly decreased. They're also starting to face some more competition, as Mr. Beast has created his own brand of chocolate called Feastables, which he continuously makes fun of Hershey's, which in turn lowers the brand equity of Hershey as people see it in a more negative light.
Like a Hershey's bar, to me, just tastes like, it tastes very processed.
On the positive side, Hershey's has always been really good at acquisitions. As you can see here, in 2021, Hershey's acquired Lily's for $425 million, and in November 21, they also acquired Dot's Pretzels for $1.2 billion. So they're also using this to diversify, as they're moving away from just chocolates to all kinds of snacks. Taking a look at Hershey's financials, their revenue has grown from 2013 being $7.1 billion to in 2022 being $10.4. It's consistently been growing, and you can see in the past couple of years since 2020, it really has gotten about $2 billion more in revenue that has become mainly from the acquisitions. Looking at their 3-year compound annual growth rate, it's 9%, and their 5-year is 7%. For a mature company like this, that is very, very good. And comparing it to its competitors like Tyson, General Mills, Kellogg's, Kraft, and Mondelez, it has a higher compound annual growth rate over the past 3 years, 8 years, and 5 years than all of them. So it is doing very, very well, and it's compounding much more than most of the other chocolate and food companies there are. Looking at their net income is growing very well too. Besides for this dip in 2015, it has done well. It has gone from $0.8 billion in 2013 to $1.6 billion in 2022, which is a 13% compound annual growth rate in the past 3 years and 16% in the past 5. Once again, this is very good for a mature company. Looking at its competitors, it is way higher than its competitors in net income. Tyson, General Mills, and Kellogg's, it is much higher than all of them in all the statistics. The only one kind of close is Mondelez, which is still below in the 3-year, 5-year, and the 10-year. Looking at Hershey's margins, their gross margin is 45%, their operating margin is 24%, and their net margin is 17%. This is very good for the industry. As you see, the industry average is 3.5% in the net margin, and theirs is 17%. Their average is 16%, and from 2018 till now, it has been between 10 and 16. Right now, for the past 3 years, it's been hovering between 17 and 16%. Comparing Hershey's to other companies in the food products industry, it's better than 93% of them. Out of 1,397 companies, Hershey has a better net margin than 93% of them, which is incredible. Looking at Hershey's free cash flow, you can see in 2015 it was $0.5 billion they had in free cash flow, and now they have $1.8 billion, which is a 8% 3-year CAGR and a 13% 15-year CAGR. This free cash flow helps Hershey continuing paying its dividend. Hershey has a 2.58% dividend yield, and they've been continuously increasing it, as you can see in this graph. They have 13 years straight of dividend growth, and they are growing in the past 5 years at an average of 9%, which is considered very fast. They also have a very good payout ratio. As you can see, it's currently 45%, and its forward payout ratio is 49%. What this means is, let's say Hershey makes $100, they're only paying out 49% in their dividend. This allows them to continuously increase their dividend or acquire more companies as they've done in the past. And finally, we're going to do a discounted cash flow. We're going to plug in a terminal growth rate of 3%, a discount rate of 7%, and a forecast period of 5 years. As you can see, that predicts that the first year will do $12 billion in revenue, and by the 5th year, it will be doing $14. With this, it gets a base case of $200 per share, which means that it would be undervalued by 4%. So do I think Hershey is a buy? I think Hershey is getting into the valuation range of a buy. I think once it gets down to something along the lines of 170, it will become much more attractive. But this is a pretty good price to start buying up some Hershey shares. And that is everything. I hope you guys enjoyed the video. If you guys did, please make sure to like and subscribe.